kind of reflective of the times, right? We talk about uh, lack of inventory, lack of buffer stocks, supply chain disruption. So we had to have a backup, and we almost had to have a backup to a backup for the session. So Todd was backing me up. I was backing Steve up. And I mean, just reflective of the theme. Uh, when we thought about this panel and looking at supply chain, I've been in the industry for a long time, and supply chain, though we tried very hard to make it front and center in the minds of clients and the industry, it took a lot of doing. But post-pandemic, whether we like it or not, it's in the headlines. We hear about port congestions, we hear about supply chain disruptions, we hear about lack of key raw materials, we hear about the missing pieces of inventories, log jams, what have you, various reasons, labor shortages, etc. So we thought we'll have a panel that represents different dimensions. So along with me, we have Sinan, who comes from the logistic world. He is with DP World Services. And Mikhail, who is from Rabobank and leads their ag business globally. So the idea today is to discuss the various dimensions of supply chain disruptions and what financial institutions and others can do to alleviate this. So maybe I start with you, Sinan. You work for a logistic firm, but you seem to represent DP World Financial Services. So maybe you want to take us through that, and then.
Sure. Thanks a lot, Suresh, and hello, everyone. Thank you for taking the time. So to put things in a context, DP World historically has been a ports and terminals operator, right? So we handle roughly 12% of the global trade from Australia to Canada and so on. Having the boots on the ground, we have seen a lot of things changing throughout the years, and we have been a part of them. And our mission has been to enable smarter trade. Okay, so we've been acquiring, improving, digitizing ports and logistics infrastructure throughout the years, simply because the infrastructure is the biggest barrier in front of global trade. So, but what is the other very, very big barrier? It's access to capital, so your trade finance gap. So that was kind of an inevitable, output of one of our ventures. In the last 10 years, indeed, we have been contemplating how we do it right. Because we have seen, speaking with our clients on the ground, exporters, importers, logistics companies, and so on and so forth, we tried to do it right from the beginning. One of those things was speaking where the trade finance gap comes from, right? So 50% of our business, the business that we handle, comes from small and medium enterprises, whereas the other 50% comes from the large corporates, MNCs, multinationals, and so on. When we looked at the financial ecosystem, from the current financial ecosystem, 10% of the funding goes to the small and medium enterprises, so your SMEs, whereas the 90% goes to the large corporates, MNCs. So it's clear where the gap lies, right? So I said, okay, but everyone talks about helping SMEs, but nobody does eventually, right? They do something, but it doesn't hit the ground, basically. So we said, let's not go naive. So we looked at the SME side. So they don't have a Harvard graduate CFO. They are lucky if they have a senior accountant, which is overwhelmed, understaffed, owner takes the calls. They don't have time to even go out in the market and understand what are the best financing options for them. They know the banks in the street, maybe in the city, maybe just a few others, right? So there's already one side of the problem already not hitting and understanding the options in the market and then being able to evaluate them. So we said, okay, let's create a platform wherein we are a single window for SMEs to access to multiple lenders across the globe. Today, for example, a lender in US is financing a Dubai SME, which was rejected by all the other lenders in the market. Or in India, we have a lender in Germany who is financing that Indian SME who is shipping to the rest of the world. But this was just a few examples we have seen. The other side, when we looked at that, it's clear that seeing at seeing the 10% of the funding going to the SME sector, which is 50% of the global trade, it's, I think, fair to say that the traditional banking system has failed the SME sector. There's no other way to put it, basically, in a nicer way, basically. We said, okay, but there are many non-bank finance companies, trade finance funds, alternative lenders coming into the mix. And they don't have a sales army like a bank does. They can't send 20 salespeople to the same door and knock all the doors. So, okay, so we can be a lead engine and originator for those lenders so that they have a cost-effective client acquisition strategy. But it's not, again, the end of it. You have to bring the banks on the business as well. And it's not, the fact that the banks don't lend enough to SMEs is not because they are evil, because there's a massive track record of having an SME portfolio higher risk, right? So default rates and so on. So, okay, let's look at the risk aspect of it and why it didn't work. So one of the biggest things is the transparency on the trade, right? So we said we have visibility on more than 90% of the global container shipping, not just DP World ports and terminals. We said, okay, let's plug them all into the same platform, whereas the lender today can check where the cargo is. Otherwise, they look at a paper bill of lading, which can be fake, forged, lost, you name it, right? So, okay. So today, on the platform, they're able to check from the container number and the BL number, first, that there's a cargo, two, where it is, and they can track it. So these are just a few initiatives to make it more transparent, but the next step is for us to also control the cargo, which we've been doing in the last 3-4 months, and eventually us to become a lender. So we also put our money where our mouth is, basically. So we are a lender now on the platform to make it more inclusive, to increase the capacity. Yeah.
Thank you, Sinan. Very, very interesting. Now, shifting to you, Mikhail, how the global geopolitical environment has undoubtedly impacted your sector significantly. How do you see that, as well as supply chain disruptions impacting commodity players? Your perspective from there.
Yeah, thanks, Raj. Just to put it out, so I represent basically the commodity traders, so the physical commodity traders that globally, I mean, we do ag, so I'm representative of ag, but we also do energy and metals, which probably globally represents about, from a monetary perspective, half of the trade that's done. But physically, as you can imagine, the amount of cargoes actually floating is much less than the regular trade. Indeed, the geopolitical complexities that we're facing at the moment, they're there. But to be fair for the traders, disruptions, or what you call them, are actually opportunities. So they are thriving. They actually can start adding value. Disruption, generally what they do, they create volatility in the price, which for a trader is actually very favorable. Flat market structures actually impacts their profitability much more than prices going up and down. And actually they can show or they can add value and make a difference by physically managing the cargoes much better. So what we have seen, particularly in container, it's a problem. That's the disrupted market. Bulk at the moment is actually pretty much back to normal. It's really the container bit. Now within commodities, you have a lot of bulk cargoes going around, metals and also grains. But for example, coffee is a containerized business. But now more and more what you see actually is that clients get stuck with inventory in Brazil, being the largest exporter. And in order to get that out, what they do is actually they start shipping it in bulk. So they go actually back to the old. And that's where I think that's where the trader really starts adding value in the supply chain and becoming much more versatile and make a difference and actually make a very good margin on the back of it. So disruption for traders are actually opportunities.
Interesting. Looking at it from my perch, given that I run trade transaction banking for BNP Paribas in the Americas, and talking to clients, what I hear from a lot of the US companies is supply chain. The word that I hear often is supply chain resiliency. Need to have inventory. Earlier we used to hear just-in-time inventory. We used to hear lean supply chains. Getting inventory at the right time, at the right place was critical. Now we are hearing more and more, I need buffer stocks. I need to be sure that I can get my widgets out when I need to get them out. So if I need raw material and I need to build. So coming back to Sinan's point, it's about, even from the buyer perspective, it is about being able to finance these inventories in a balance sheet efficient way, but also a cost efficient way. Now, back to you, Mikhail. How do you see the digital dimension play into this space? Because you and I talked about digital dimension earlier. What do you see is, do you see a digital dimension playing a role?
I mean, I think we all probably agree that digital has to play, but I also kind of echo what Mark on the previous panel mentioned, that in the commodity space in 2020 we had a huge amount of fraud cases. Banks actually lost billions in total. It created a sense of urgency, but for some reason banks are also like goldfish, and within 3 years they have lost their memory, and we're pretty much back to square one. And I also echo the frustration with Mark. So I've taken this role on 12 months ago. Before that, I was pushing the digital agenda within our department. Holy moly, it takes a lot of time. But I think it's not only there are multiple problems. One is that you have the banks need to be secure, and you have the whole discussion about the amount of hoops that you need to jump through to get things approved. Then there is, particularly in trade, we are still running with BLs, which are effectively still a paper business, which is insane, and everyone's been shouting it's insane, but it's from a legal perspective, it's also not acknowledged. A digital document is still not acknowledged in every jurisdiction. That's where the struggle is. So it is obviously a complex problem, but I would say that the versatility of banks is to improve on that one. And I guess that's where money to go, or where the emphasis is, but that's where they can play a role. Yeah, sure.
And Sinan, from the logistic perspective, do you see solutions, structural solutions emerging to some of the topics Mikhail brings to the table?
Suresh, I think the scale and the complexity of the global trade is huge, right? So it is unparalleled, really. It has multiple intermediaries, information asymmetry, paper-intensive environment, and so on. So, in fact, the 15% of the value of the goods are of hidden cost, due to manual processes. So how that fits into how we operate today is actually the lack of having real trade data. So I'm an ex-banker, so we operate based on the paper. So we don't really have a need to understand what actually goes on the ground. But the solutions that actually hit the underlying trade, that actually see the underlying trade, can actually solve for today's problems. In fact, the corruption cases or fraud cases or default cases that we have seen in 2020 was primarily not having real trade data. There's a lot of collusion between fake invoices, fake BLs, or double invoices, and so on. But if you can connect that shipping document to the real trade and to the real invoice, then you can solve for it. And those are the things that can help solve today's SME trade finance gap, or overall access to capital, and so on.
Suresh, maybe if I can jump into this, and I completely echo what Sinan says. The problem is that we rely too much on the client. That there is only bilateral, and you need the network effect to reduce fraud risk. It will never be abolished, but and to be fair, so I was putting it like nothing is happening. Things are certainly happening. Also on the commodity side, there are actually platforms arising, finally allowing multiple players, the ecosystem, a fantastic term in the digital world, but to start connecting, so that we go into the warehouses and get independently verified if the stocks are really there. You go to insurance firms, whether the insurance, anyway. So that network effect of platforms, and those platforms are actually arising. So things are happening, just in my opinion, still way too slow.
Excellent. Now, given that we are between lunch and a bunch of people, I'm going to ask a one-word or a one-sentence response on two topics from both of you. and then we'll open the floor to questions so that we can get some reaction from the audience. The question is, when do you see the supply chain disruptions ease? When do you think it's going off the headlines? That's one question. Secondly, this is a bunch of very powerful financial institutions in this room. What should this audience be doing on this topic? I think those are my two questions to the two of you. Whoever wants to go first, go ahead. Please.
So I think last 2.5 years has shown us how fragile the supply chains are. And that's not even only COVID related. I mean, when Evergreen vessel, hit the Suez Canal, has nothing to do with the COVID. And the one thing that emerged from it is that actually you need to have multiple plans and minimize your reliances on single way of doing things, because we're not doing business that we were doing 10 years ago, and we're not going to do business 10 years from now, same as we do today. And we have seen a lot of players in the market, banks and carriers, who thought the scale was the key. Instead of innovating, they just pushed on the scale and emerged and consolidated. When the markets fluctuated, they actually found themselves only overexposed. When bubble finally burst in 2008, they didn't find a forward-thinking Lehman Brothers. They found the bank still operating based on the principles that it developed in the 1980s. Similarly, when they finished the autopsy of Hanjin, the Korean shipping line that went bankrupt recently, they're not going to find a carrier full of innovation. They're going to find a desperate fight to retain status quo. So I think that's the part that we have to make it clear in our minds. It's not just about when, because it's going to happen all over again. It's just you create more inclusive and forced collaboration and drive the digitization for the real trade to control and have transparency on the real trade.
And Mikhail?
Well, I think actually the question is more not like when it's solved, but it's more how much more disrupted will they be? And that, I mean, commodities and geopolitics are closer than ever. And the question here really is obviously you have Russia-Ukrainian situation, then we have the China-Taiwan situation, and to what extent they escalate or de-escalate, that will very much drive the disrupted commodity markets. In a worst case, I mean, and actually, again, for the trader, that's all positive up to the moment that you get disconnected markets due to sanctions. I mean, sanctions, we all have to deal with them, but particularly in the commodity space, it's the name of the game at the moment. If you get disconnected markets due to sanctions, then that's a whole new shakeout. But up to that moment, it's just very disrupted, and the traders will play a role in that to solve that.
You're right, and I also think that there is going to be incentive globally to create more manufacturing hubs closer to where the use is. But so we're going to see a change in the whole supply chain model. One source coming from 6 weeks away is not necessarily going to be the model of the future, perhaps, and it's going to change the way we look at financing.
But to be fair, in my opinion, that doesn't necessarily affect trade. The whole producing your own country, that just changes the trade flow.
It changes the trade flow.
But there is still going to be trade up to the moment that we say we have two different worlds. Yeah.
Excellent. So open to the audience for questions. I think we tried to cover some of the ground. It's a vast topic. So please feel free. Any takers, or is lunch more attractive? Huh?
Can I?
Sure, go ahead.
When do you see this ending?
I asked these two, and they refused to answer.
No, it's important to know. I mean, we've been going through this for a period in time. Whether your car comes in, or your food grains come in, or your oil comes in, it's been a challenge, right? But equilibrium has to come at some point. At which point is that equilibrium going
My
to be there?
take is we will overcorrect in some areas. In some sectors, we are going to overcorrect. People are starting to build those buffer stocks we are talking about. And there are solutions out there that financial institutions are putting together with corporates to handle building those inventory needs to finance them. Now, there's going to be an overcorrection because they're, as I think Mikhail said it earlier, we're like goldfish, right? So people are going to forget that this problem existed when they see that their balance sheets have more inventory or their finance. They're going to go back somewhat. But the challenge is not going to go away completely ever, I think. It's going, because I think we are in a unique, COVID just exposed what was a problem already,
Absolutely.
right?
I think, I mean, to answer to that question a little bit more directly, I mean, there are many predictions, right? So the expectation was overall mid-2023, it will be, easing up and so on, right? But the container prices are already coming down. So which problem are we talking about? Is it the container prices? Is it the supply chain? Is it the fragility of it? That's what I'm trying to say. I mean, we can say this will ease up in the next
Something
3
else
months,
will
and it
come up.
actually can anticipate. But there are going to be new things. We have to always think of how we can, make our supply chains more robust. It's one of the things that Suresh, you were saying. It's not just about just in time, but also just in case inventory management. We speak with these companies day in and out every day with the clients that use our ports, terminals, warehouse, free zones, and so on. And especially in these days, two things came out from the CFOs very clearly. Uncertainty has came out as the number, as the higher umbrella topic, and it translates into working capital management. I am worried about that. It translates into how am I going to finance my inventory? That's the two things from the CFOs under the uncertainty umbrella. And that's inventory finance is practically your just in case.
And we
part.
in supply chain industry as the banks have been focused primarily on extension of payables and increasingly on monetization of receivables. So as an industry, the focus on the DIO has been less pronounced than the focus on DPO and DSO. So I think that's for me an important takeaway.
Suresh, on the commodities, that's different.
Yeah,
So
commodities
we,
is different,
we either finance or actually banks hold them on the balance sheet. We buy and sell them back. I mean, you have various solutions.
The
out there.
commodity
And that
sector,
is-
yes,
and
yeah.
that's it. Yeah, and there is a huge opportunity for us as well.
Excellent.
In fact, thrives from the ups and downs.
Yeah.
Thank you. I think this question is for Sanan. And first, I have to say, just my own personal experience when I went to Expo 2020, the DP World exhibition probably was the most impactful for me, and the vision that I think I saw on how you all perceive automating the freight and supply movement to me was fascinating. But you talked about the imbalance between sort of large corporate MNC business versus SME business. And I know specifically within the trade finance world, trying to get automation down to the SME and that last mile has been the hardest thing for any of us to do. So when you think about deploying technology in a way that's going to solve for SME problems, how do you think that's going to happen?
Thanks a lot, Todd. I mean, there are a few different ways of doing it in different parts, but eventually it comes down to every player in our ecosystem to chip into it. But trade is a team sport, basically. It's just continuing in silos, carriers, banks, shipping lines, forwarders, exports. It's just not helping it, right? And nobody collaborates just for the sake of collaboration either. It's a forced situation that we got to do. I'll give you one example how it plays out. We've been, for example, in the last 3-4 months, piloting a specific project wherein we use completely our infrastructure. The plan is to deploy it to the multiple fronts, but there was an SME exporter in India, in north, somewhere close to called Panipat. And this company is the definition of your trade finance gap. It has good products, secured a good, decent buyer, but not Walmart or something. It's just mid-sized company with a good contract that can deal with. And this company was rejected by all the lenders that it applied to. And in fact, even on our platform, it was first rejected by the lenders. We said, you know what, this is the reason why we are in this business. So let's put our hands together and find a solution to it. So we said we have drawn a map from where the cargo is coming and where it will go to. So we put it on our inland depot in Panipat and issued a house bill of lading. Normally, forwarders can issue house bill. DP World is licensed to do it, basically. We said we put it on our depot, and we put it on a rail after the depot, which is again operated by DP World. Brought to Navashava port in West India, again DP World operated. Or put on a shipping line, Unifeeder, again DP World's shipping line. Brought to Jebel Ali Free Zone, again DP World, and brought to a warehouse in Jafsa, Jebel Ali Free Zone, basically. And I said, okay, this is a trade that we handle. We control the cargo physically, and that company eventually got financed by the lenders on the platform, which was rejected before. And now we digitize it. So this is the part, it's a lot of work, Todd. It's not easy. Even internally, I give the example of supply chain finance. Many of the supply chain finance programs have failed miserably, right? It's not because of the risk or the price, it's because of the complexity. It is complex, but I think the bigger players like DP World and the banks eventually need to put their hands together to find a solution for it. Otherwise, it's just not going to happen on its own. Hope this helps to answer with a concrete example.
Just a quick question for maybe Mikhail first and Sinan. You talked about the just-in-time versus just-in-case and the rise of that. If you're holding inventories and they're inflating at the rate of inflation, and the cost of carry, the financing cost is through the roof, doesn't that increase that trade finance gap a little bit more? And what are the banks doing, especially in view of the SCF disclosures that are coming in, which is going to make it even harder or more difficult to actually offer those structures that have been there before? And where does that leave the trade finance gap for the small guys?
I'm not sure if I understood exactly. Can you elaborate a little bit more? So does putting the more commodity in the warehouse increase the trade finance gap, you said?
Yeah, I mean, the cost to corporates is going to be increasing.
Okay.
Just to carry out that same activity. And if it's actually difficult for the SMEs to compete today in that new environment, are they going to find it even harder?
Well, actually, the otherwise is not having it at all. Because just-in-time is just not working. The cost is way bigger. But identifying the right inventory financing structures actually can optimize that. That's why I give you another concrete example like I gave to Todd. There's a company in Jebel Ali Free Zone, which is a new build-up, one-year company. Nobody finances them again. Another definition of trade finance gap. So that secured a contract from a coffee exporter in Brazil. And what we have done, we have tied up with a warehouse, issued e-warrant, and got it financed by a lender on the platform again. That less than 1 year company, because it has a good contract, and again, selling to the supermarkets, and it optimized drastically. Otherwise, that trade was not going to happen, just like on the first one. It is $1.7 trillion trade finance gap. The trade not happening due to lack of finance is this.
And I would actually argue that if the expectation of underlying inflation is still there, the need to build buffer inventory stocks and lock in supplies might actually be higher than if it were not. So you're right, in some ways it builds the gap, but it is not because of the actual realized price increase, but it is more because of the anticipated price increase, which might make it interesting for acquisition of inventories in anticipation.
But maybe from the commodities perspective, I do agree. It's already becoming a big boys game, commodities in general, and this is obviously not helping that.
Yeah.
That the cost of finance is becoming a more important part of the actual underlying price, and actually is a differentiator. Yeah, so if the ability to attract liquidity, it's both pricing but also just sheer liquidity, availability of liquidity, and that is moving away from the smaller to basically the niche or the mid-sized traders to the larger traders. So yes, very much so. Yeah. lunch.
Food.
Thank you. It's lunch.
There you go.